Hello, you're very welcome to this episode of the Connected Advice podcast. I'm so happy again to be joined by George, our tax partner. You're very welcome, George.
Thanks, Paul. How are you doing?
In the last episode, we talked about mastering tax planning, which was a 3-year strategy, and we explored how the 3-year cycle transforms efficiency and gives you peace of mind. This week, we're expanding on that, and the talk about this year and the questions are coming is why year-to-year tax planning fails families. Right. So this is the question, like why by just doing something and just concentrating on the 1 year. And I have a series of questions, George, as usual, to ask you in this and just get your opinion on it, really.
Okay, all right.
So why is 1-year tax planning broken from your perspective?
It just doesn't give you enough time to put the kind of plan that you need to put in place for yourself and your family. Like, for instance, there's a number of different tax reliefs that require a number of years as a condition to qualify for them. So we've spoken previously about revised entrepreneur relief. For instance, that relief requires ownership of the asset for 3 years. So if we're trying to structure a plan so that the client can avail of that relief, we may not have time to do so if we're working within a constraint of 6 months or 12 months. We may need time to do it. That's just one example. There's loads of different reliefs, like I said, that actually require a time frame. As well as that, it probably doesn't give you time for putting a transition in place. If you're talking about passing on a family business and what have you, you need to start working towards, aside from the tax side of it, you need to start working towards the successor coming in and getting their feet under the table, if you like, towards running the business and taking it forward. So that's just a couple of the reasons. But there's plenty. Like anything in this life, you want to give yourself time to put the best plan in place to make the right decisions for yourself, your family, and your business.
And I suppose the next question then is following on from that, like there's simple things like capital gains allowances. Some of these allowances and release, you either use them or you lose them.
Yeah, so each year you're allowed to have gains of up to €1,270. So it's a relatively small amount, but it's a situation like if you had an asset, that maybe was valued at €5,000 or €6,000, if you sell it in 1 year, €6,000 asset, you might pay 1,500, $2,000 in CGT. If you sell those shares, for instance, over 3 or 4 years, you might pay very little tax. So obviously that's different on different circumstances and how quickly people need access to the money and all those things. But yeah, at least if you've got time to plan it, you've got time to make the decision that's best for you.
For using the likes of your capital gains tax allowance, like bed and breakfast, is that still something that's...
Yeah, it's not something we see too much of, anymore. But yeah, like I said, in the most basic sense, if you're talking about the allowance, like I know we would have clients here who have shares, in different in companies, and they sell those shares year on year just to benefit from the 1270 allowance, as opposed to selling them in one kind of foul swoop.
Yeah, and if you have a husband and wife or partners that are...
You double up that allowance.
You double up the allowance. So suddenly, over 5 years, this becomes, 2,500. So it starts to become worthwhile.
2,500 over 10 years is 25,000. Yeah.
Yeah. The other question really here is siloed advice causes stress. And what I mean by siloed advice is, and there's nothing wrong with siloed advice, but it just causes massive amount of stress. We see year-end panic when it comes to tax deadlines. And then within that year-end panic, you have things like pension payments coming up because you can pay a pension for cover last year's within this year's. And that's that advice then. And then you're trying to connect all these people together. You're trying to connect, the lender potentially, because some people borrow the money to pay their tax and their pension payment. So you have a bank, you have the financial advisor, you have the client. So you have all these number of people again that are all giving their own opinion, but there's no one. And then I'm the client here, so I've the stress of this. Is it the right thing to do a pension? Should I maximize my pension contribution today? And if I don't maximize my pension, do I lose that allowance on my tax?
Yeah, and look, that ties back a little bit too into the giving yourself time. But yeah, like you could have a situation where you're leaving in your income tax information or whatever it might be, your tax information relatively late in the day. Your accountant, your advisor is struggling to get it done before a deadline. So maybe they're not necessarily thinking about what reliefs, what are there best for you to allow you to be as tax efficient as you can be. Like I said, your pension advisor is giving you advice with a view to grow in your fund and different things, but maybe not necessarily tying in the tax efficiency or the timing of the pension contributions as they should be, or the form of the pension. As in depending on your level of your source of income, you should be putting into a different type of pension to get the full tax relief. So if that's not all being pulled together, it can lead to difficulties. We had a client relatively recently where we're looking at the pension for a GP, and he had a couple of different sources of income. So to get full tax relief, the actual form of the pension contributions had to be split between those different types of pension. If you don't give yourself time to do that, if you leave it till the last week, or if you're rushed up against a deadline, you're just not going to get that level of, like kind of said, joined up thinking where we're able to go to the pension advisor, say, actually, we need to do this, or the tax relief is going to be a lot less, because obviously it'd be easier for the pension advisor is going to be just thinking to himself, well, the client wants to invest X amount of money, I'm going to put it in this pension fund, not necessarily being aware of the split of income that client has. So absolutely, it works better if everybody's on the same page, everybody can work together, and everyone has time to work together.
And as this connected advice, obviously the name of the podcast is Connected Advice, but it's the whole concept of this idea of bringing the people together, the likes of your pension advisor. And we're looking at tax planning, and we're talking here about your annual income tax planning. But there's a lot of other taxes there that you need to be planning for. And looking at, at lastminute.com has a massive stress level for people that there's no need to.
Yeah, people will go visit their solicitor. Their solicitor would say, you should transfer this property now, get it across to your son or whatever it might be. And there might be genuine kind of legal reasons for that.
And it's great advice.
Yeah. But they mightn't have necessarily thought of the tax consequences of doing it. So that's where, if everyone can join up together, and at least then you can work on the pros and cons of any decision, that you've the legal side, the tax side, the commercial side, all tied in together. At least then the client is making an informed decision. And whatever they decide to do, they're aware of the impact of that decision. Whereas if you're just rushing it through, and we're finding out 6 months later that you've disposed of a property when we go to do your CGT return, there may or may not be a liability there. And it may be a liability that if we'd had a chance to talk to the client before the transfer happened, we might have been able to do something to reduce that liability. We've seen plenty of cases like that over the years where, if somebody just had that time or take that time to plan out those transfers, there might be savings to be had.
And there's the, I suppose, not just in the standard personal taxes that apply. The same thing applies to what we call, I won't say the hidden taxes, but the taxes that are never really, they're not recurring on an annual basis. Like there would be VAT as a transaction tax. So each transaction needs to be, so again, you need to have the time to plan.
Absolutely.
There's stamp duty reliefs. So like we've talked a lot about the retirement relief and having an entrepreneurial relief and that side of it. But the taxes that are usually not spoken a lot about are the taxes that absolutely need time to plan.
I've had clients come into me with a view to do tax planning, but they've already started the process. So you could have a situation where, a client has a business and a farm, and because they started transferring shares in the business before they've come to speak to us, to their son or daughter or whoever it might be, agricultural relief there might have been there on the transfer of the farm is no longer available, just because as a consequence of timing. Whereas with a bit of planning, it might have been a situation where, the farm might have transferred first to allow that relief to be claimed. Like, there's plenty of instances of that over the years where, like I said, people have made decisions with the information that available at that time, but unaware of the impact that decision might have. So I've had plenty of people come into me over the years where they've transferred shares in a family business to their son or daughter, and now they want to transfer the property. I had a case a few years ago where they came to us and they had transferred the shares about 6 months before they met us, and now they wanted to transfer the property that the business operated from to the child. And if they had transferred the property at the same time as the shares, there was tax reliefs available. But now, because the shares are transferred first, the property no longer qualified for those reliefs. And, unfortunately, we had to tell that client that there was quite large tax costs to transfer the property. And they'd made decisions with, the best intentions. But it's just that, like you said earlier, giving yourself time to plot out what's going to happen with the shares, with the property, with other family assets, is not something that you want to be doing in a rush, because you leave yourself open to making, mistakes like that.
And then, the title of this is Why Year to Year Fails Families. And it fails families because of these. It's not so much, and it is a lot of cases, there's a lot of unused allowances, and, you use them or you lose them because they're an annualized based on allowance. And one particular one that you're very much talk about, and it's something that's not talked about enough, is the annual gift allowance and building wealth for the next. Could you just like to comment on that?
Yeah, I mean, there's a gift exemption called a small gift exemption. It's for €3,000 a year. So essentially, and you can receive €3,000 from anybody before you have to account for that in terms of paying CAT or reducing your threshold. So it doesn't sound like an awful lot, but if in a family situation, if there's a mother and father and there's three kids, well, then each kid can receive 3,000 from each of their parents, so that's 6,000 a year. There's three kids, so that's 18,000 a year. You do that over 10 to 20 years, you're up to 20 years, you're up to maybe 360,000 that is transferred free of future gift or inheritance tax. That's potential saving of €120,000 within that.
See, like that's information that people actually really need to know. Do you know what I mean? And it's the little siloed tips that you have there that are really important. So, again, come out with a 1 year mindset for everything to do with this, everything to do with tax planning. So, I suppose, what's the alternative?
Historically, like, accountancy practice has been a little bit reactive in the sense that we do last year's tax return. We sit down and we look at what your figures were last year. We look at what you did last year. The alternative is you're just constantly behind yourself. You're not thinking forward. You're not looking forward. You're not seeing what you need to do in the next 3 to 5 to 10 years to put yourself in the best place to allow you to retire, or whatever, that live the life you want to live, or whatever it might be. So that's what you need to be. You need to be settling down to put a plan in place. Like, I have a number of clients where we put plans in place maybe 3, 4, 5 years ago. And we meet regularly to see if the plan still makes sense. If we need to make a little adjustment here and there, if we're still on the right road to where we want to end up. That's the kind of long-term tax planning advice that you're looking to ideally you put in place. Yeah, and like you said, you join that up then with your other advisors, with your pension advisor, with your legal team, that everybody is involved, that we get the most kind of rounded advice that we possibly can get when we put that plan.
As a business owner, that's so powerful, because as a business owner, you have somebody sitting in your chair beside you, helping you bring together your whole. It's the kind of a family office scenario that we talk about here, that you sit with or I sit, or somebody sits with the client. And our motto has been the family first scenario. And we have built this framework called the family bridge, and it comes into the business bridge, and these connect all this stuff together. But the benefits are here is that you're not losing the small tips that really matter, but it gives you an alternative, and it helps you build this one vision for you. And everybody's vision for their own personal life is different. That's why we start with the family. But it gives you the one vision, and it helps you to put one plan in place, and it helps you to build one team of people around you. So imagine that you have corporate finance, financial advisor, tax advisor, accountant, and all these people are coming together and they're helping you create the journey. Whether you're on one of the first startup, a grow, a scale, or a harvest, each step of that journey needs all of that advice and needs to be planned out. This is something I'm very passionate about, because I think it's the way forward for people, but it takes you off the back foot.
When everyone's rowing in the same direction, you're not being pulled different ways by different advice coming at you from different angles. Everybody's kind of rowing in the same direction for what that end goal is.
Because all the advice that all the people are giving is great advice, but it's that secret sauce within that advice. It's the project management of that advice that connects the dots, that stops the firefighting and the scrambling, and stops this 1 year for the families, and it builds the family trust. And it's like family decisions for business owners is a really difficult position. It's a difficult position to know what to do with your wealth. It's a difficult position to know how to understand, how do I transfer this? If I have a lot of wealth, is a problem. If I don't have enough, I want to divide it up evenly. So all these are questions that you need somebody to sit with you to help you go through those questions. And that's what we do here. That's our job.
Yeah, absolutely. That's what we're here to help people with. Like you said, everyone's case is a little bit different. Every family is a little bit different. There's a wrinkle here or there that, differentiates one case from the other. But it's the experience of dealing with all those different cases over years and years and years.
It's what connects it all up.
Yeah, exactly.
There's two things I want to leave you with here. So it's behind every number is a family decision, right? And that's so important, but then for me, it's not about the answers. It's about the questions that we're there to ask. So we'll put the questions out there because of the experience that's in our practice. But if you put 5 really strong professional individuals together, and those questions now become, they become multiplied by a factor of, could be a factor of 5, could be a factor of 10, and now you're protected, and now you have the whole group together, and that's what kind of I want to leave everybody with. So thanks again. The next episode will be coming up, and in the next episode we will talk about the next stage of this tax planning. Thank you so much.
Thank you. Take care.